Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
That's a fascinating point, I think, around control. And I suppose this lever of control, whether that's something that is in the hands of the president and that can be manipulated as in that way. And let's hold that thought on tariffs, because that did certainly raise its head over the course of this week. Just cycling before we get into a broader a check on the on what we're seeing in terms of the economic vibes. I think it is important to touch on borrowing. Haven't seen much Fed news this week, but it is notable that Man Group has a significant presence in the UK. I sit in the UK. UK long-term borrowing costs hitting their highest level since 1998. Not a marker point that many like to look back to. And we have seen that if we compare gilts to other, say, government bonds, like in the US, like in Germany, everybody has seen a gap out in their yields 30-year over the course of the war, but none more so than the UK. And as I said, that 28-year mark is very notable. How do you see if the bond market is seen as a barometer of sentiment? And this movement that we're seeing in treasuries, first of all, over the last few days, and what does that say about expectations? But in particular, what does the gilt movement say about expectations?
Well, that's a great question. And I think the bond market tells us so many different things. It's a reflection of fear, but it's also a reflection of perceptions around fiscal sustainability. And so we have seen this departure really since around that trust moment several years ago, where UK gilt yields have been higher on the long end than other major economies, even though other government bond yields are in economies where there is more government debt as a percentage of GDP than the UK. So I think that there was some trust lost with that failed budget that sent gilt yields up and really never brought them fully down to where they were in terms of their relationship to other long-term government bond yields. But having said that, again, this is, as you pointed out, a phenomenon that many other developed countries are experiencing. And I think it goes to bond vigilantism. Mm-hmm. There is growing skepticism around government's ability, whether it's the UK, whether it's France, whether it's the US, to rein in spending and set forth on a path of fiscal sustainability. There is absolutely nothing, for example, that the US is doing that should give any confidence to bond owners that it is looking to be fiscally sustainable. We heard that Doge saved no money. It may have cost money. We're seeing enormous expenditures in terms of defense spending. The asks for $1 billion ballroom, the list goes on and on. There's just not that kind of fiscal prudence that we saw in the late 1990s when the U.S. successfully cut spending with a bipartisan committee and actually delivered budget surpluses for several quarters. I'm old enough to remember that. There were attempts even in the early 2010s to rein in spending, and there was some success with that. There's not even an attempt this time. So I think we're in a very, very different environment. Countries spent a lot during the pandemic. Understandably, they needed to provide fiscal stimulus, and I'm not going to second guess that. But now is a time when you're not in a recession to get one's fiscal house in order so you're prepared for the next crisis. And a number of countries aren't doing that. Now, Japan is a unique case because it has lagged other economies in terms of seeing any inflation, right? Its bigger issue was the absence of inflation. And it's an economy that hasn't seen the growth that they'd like to have seen over the last several decades. So we're seeing a lot of interest in fiscal spending. That is really the plan of Takaishi. And, I think of it as Abenomics 2.0 on steroids. And that's also being met with some skepticism as well. So we're in an environment where there's concern about debt, and with good reason.
Well, it's a fascinating question. And I think it echoes a little bit what we spoke about before in terms of factors that are within control or not within control. And we've to mention the Bank of England in this, it was mentioned in the headline in terms of whether it will raise rates 2 or 3 times to counter the inflation threat. Because there is a narrative that's circulating currently that is that markets and investors are behaving as they do because in a way it's almost like that question, what would you do if you knew you could not fail or you believed you could not fail? Because if you believed that the government institutions would step up and avert disaster. And here, in fact, we have the specter of the government institution not stepping up to avoid disaster, but being impossible to act otherwise in terms of needing to raise rates. So I suppose it is that question of whether there will be a benevolent central bank or whether the new central bank under a new chair will be less inclined to be benevolent and less inclined to step in. I know we have had a change of the guard, or change of the guard is certainly on the topic. Do you see Fed policy as changing notably?
I don't, certainly not in the near term, because you have a number of members of the Fed that are clearly concerned about inflation. They have the specter of, what happened in the 1970s, and again, the mistakes that were made in the pandemic, not acting quickly enough. So I think, the vast majority of voting members of the FOMC will stick to their guns. I think the market expectations have now changed, and no rate cuts are expected this year. And I think that's right. And I do think we run the risk of being in a more stagflationary environment where we actually see a rate hike. That might be the next move by the Fed.